growth is coming from customers we have been servicing for many years, and it's basically either getting onto new platforms of theirs or growing on existing platforms.
Sure. And which segment is it? So you mentioned tractors. Are you also getting?
Yeah. So the segments where we are seeing growth, actually the second quarter specifically, if you ask me, I would say construction equipment export growth was substantial. Agriculture tractor growth was substantial. There was growth in aluminum wheels, and there was growth in the windmill segment. So basically, we have this off-highway segment, which is agriculture tractor and construction. We have the aluminum wheel segment, and we have the windmill segment. These are the three pillars of growth for us on exports.
Sure. And the aluminum wheel plant, so what is the current utilization that we are running at?
Yeah, so we had kind of cleared a phase one, which was 350,000. So against 350,000, we are right now around in the 20s. So which means we're at kind of like a 70% type of utilization at the current moment. But this will keep getting updated. So because as we add, we also have equipments which we have ordered, which are yet to come in. So that will go up, but also the sales that we generate from it will go up.
And this is primarily only for the export market, is it? The aluminum.
This is only for the export market, but we have also won some domestic business, but that will take 2 years before it comes on stream. And we have also started selling aluminum wheels in the aftermarket in India.
Got it. Also, just wanted to understand a little bit on the commodity costs. So I believe your steel and aluminum costs have obviously gone through the roof in the last 7-8 months. So what sort of pass-through arrangements do we work with? What is the typical lag before we start, gaining, our margins back?
Yeah, so domestic, I think it's a pretty clean pass-through because it's kind of almost done concurrently with the suppliers and the OEM. On the export markets, there is a lag because there's a quarterly settlement. Mm-hmm. So if you miss a settlement date, then it gets shifted, and the month from which it's effective also varies. So there was a little bit. If you look at the last quarter, there might have been in some of the export segments, notably the windmill segment, and to some extent the construction segment, there might have been a lag of about 2 months. But that's about it.
Got it. All right, so I'll get back in the queue. Thank you so much for answering.
Thank you.
Thank you very much. A reminder for the participant to ask a question. You may please press star and 1. The next question is from the line of Nilesh Doshi from Green Lantern Capital. Please go ahead.
Yeah, so thank you for taking my question. Sir, in case of exports, you explained that the pass-through is with a lag effect of about 2 months or sometimes a quarter, let's say. But that means that whenever you have an order, you would have booked the raw material for the next 3 months, because if your pass-through itself is 2 months lag or 3 months lag, then typically industry procures for that 2 to 3 months in advance, so that the margins are not generally impacted. So am I missing something in this understanding?
No, the automotive industry doesn't work like that. Material is got just in time. And also, in case you haven't noticed, the commodity prices have gone up. So it's not as if material availability is there. Material is also kind of in short supply.
Okay.
So we just about are getting the material in time to do the exports. It's not as if we are able to build up stock, especially on the export market where there's a sudden growth.
Achha. So we don't build up inventory in advance of 2 months or 3 months, having some schedule of dispatches over the next 2 to 3 months?
Yeah, the supplies has been a bit erratic, to be honest. Hopefully it will stabilize.
Yeah, because when we compare us with the competitor, we find that their margins are pretty strong in the range of 12 to...
See, we are not... You have to understand that we are not exactly comparable. The competitor is not in the windmill business. He is not in the global agricultural and construction equipment business. The only business that we compete with the competitor in this company is really the domestic tractor business, the domestic commercial vehicle business,
I see.
and the passenger car business, which represents everything in total, maybe half the business of the company.
Uh-huh. So, sir, in that case, do we reach a similar kind of profile over, let's say, next quarter or somewhere sooner?
No, I can't. I can only tell you that the company is on a certain trajectory in terms of the export growth, and this growth is likely to continue. We expect that we will move before the end of the year. We'll move closer to 30% of our sales coming from export, even as the domestic market grows.
Okay, thank you, sir.
Thank you very much. Anyone who wishes to ask any question may please press star and 1. The next question is from the line of Pritesh Chheda from Lucky Investment. Please go ahead.
Sir, in the 28-72 mix that you are calling out for exports to domestic, within domestic, if you could give us what is the mix of PV, off-highway, CV, if it is possible?
Raghunathan, would you have that detail with you?
Yes, sir. CV is around 9
You're asking for the quarter or you're asking for the half? If I may just...
No, it's okay. You can give us for the half. And you can give us a general also. It's okay. We don't want just a ballpark understanding there.
Okay.
Commercial vehicle, that is medium and LCV put together should be around 22% of the domestic. And construction and mining should be around 10%. And in-mill segment will be around 14%.
He's asking about the domestic. What is the domestic breakup of? He asked actually passenger vehicle, commercial vehicle, and I think that's what he asked.
So CV is 22, off-highway is 10, windmill is 14. Any other segment? Pascar is?
Passenger vehicles.
Tractor will be 33.
33.
33.
Okay.
So how can passenger vehicles, Raghunathan? How can passenger vehicles be 33% of our domestic? No, he's asking passenger vehicles. Can you answer the question, please?
Yeah. So tractor is 33, passenger car.
Passenger vehicles is what he's asking. Can you answer the question, please?
7%.
7%. Yeah.
Okay. And this is of the 70%, right? This you are not giving as a percentage of your total sales.
No, this is percentage of total sales that we are saying.
Okay, this is percentage of the total sales and all of the domestic numbers basically, and to which we have to add the export part.
Other than tractor, which he said is 23%.
Okay, and to which we have to then add the export, right?
Yeah, there are also other divisions which are doing domestic sales. So on industrial components, there are other divisions which do sales. There's air suspension, which again is domestic sales.
Okay. And sir, to one other question which you answered on this aluminium wheels.
Yeah.
So it's a 350 lakh or 350,000 ton plant, in which the utilization of that plant is 70%, or out of that 350, some plant is installed. Because you also said
some is coming anytime. So right now, there was a delay in the equipment coming in because of the sudden boom in global markets post pandemic. So there's some delay. Whatever has come, we are doing now to 21,000. That balance part should come very shortly, after which we can increase the volumes.
whatever is installed, 70% utilization is there on that capacity, right?
Yeah.
So how much is installed out of that 350,000? What is the current plant capacity?
So
What is operational?
So basically, if you look at it, we said 350,000. 350,000 means roughly about 30,000 a month. We are doing about 20,000, but probably with what we have, what we could probably do would be max of 25. So we have to wait for the surplus equipment to come to increase it. This is really more a debottlenecking of existing process.
Okay, so basically what is operational is 25,000 vehicle wheels per month, and what you're producing is basically 20,000 wheels.
Yeah.
Okay.
Yeah.
And what is the project capex for this? The total 350,000 ton, 350,000 wheels.
The capex, Raghunathan, correct me if I'm wrong. The capex which is approved is about 170 crores. I think 155 crores is already installed. Balance 15 crores will be installed in due course.
Yes, and we should take a realization per wheel of 3,000.
No, this is all in the export market. So there's a big difference in terms of the. You have to understand this is a high variety plant.
Okay.
So we can do a batch size of 2.
Okay.
We can also do a batch size of 2,000 in the same plant. So it has got high variety. Every month we make close to 100 different wheels.
Okay. So based on
different business models than your typical OEM, because this is really for the aftermarket.
Okay. So based on the product mix, what should be the asset turn, sir?
350,000. Just 1 second. Let me just use an Excel and answer you. Just 1 second.
Yeah, I'm actually referring to the calculator only.
Yeah. The Excel is a calculator, but I'm talking to you on the phone, and I have the computer accessibility, which is why I'm using the Excel. Otherwise, I would use my phone calculator itself. Just a second. Yeah, 350,000. It's 175 crores. So it's more like a 1:1. See, the challenge in this type of this statement is that actually if you look at our paint plant or our heat treatment plant, the heat treatment plant and paint plant are actually designed closer for 750,000 or 800,000, something like that. So when we ramp up, when we double our capacity, we will not be investing in that. But based on the current capacity, the honest feedback would be a 1:1. But when we add capacity, the amount of incremental investment that we need to make will be marginal.
Okay.
I'm not sure if I completely answered your question, but I'm trying my best.
So when you incrementally add the capacity, at that time, what will be the asset turn? So one portion of the capacity you need not add.
Okay. I can probably answer that. That will be 255. Wait. Okay, so then it will be. Yeah, it will be closer to 1.5. But it's more like a 1.5 type of asset term.
Perfect. And margins in the business?
The margins in the business in terms of EBITDA margins will be a double-digit margin.
Okay. Thank you very much, sir. And all the best. And happy Diwali. Thank you very much, sir.
Thank you. Happy Diwali to you too.
Thank you.
Thank you very much. A reminder for the participant to ask a question. You may please press star and 1. The next question is from the line of Karthikeyan from Suyash Advisor. Please go ahead.
Sir, good afternoon. Can you talk a bit more about the outlook for profitability, sir? It is not very clear. One, of course, is the challenge of numerator and denominator because steel prices have gone up. So maybe per ton of metal process, there is a profitability is maintained, but maybe it doesn't reflect in the arithmetic. So can you talk about how to think about profitability? Plus, when you talk about a double-digit margin, the ROCs don't add up, to a substantial number. So, can you share some thoughts on this also? How you think about ROCs?
Yeah, see, a double-digit margin on EBITDA on a capital-intensive site will actually depend on your relative capacity utilization of the ultimate capacity that comes in. So the gentleman earlier had asked about what I will be at full capacity and what will be the. So the earlier conversation. If you look at it, while you have an EBITDA, it really depends on how much you're utilizing. You need to overcome your fixed costs.
Right.
Now, in terms of overall profitability, other than making a broad comment that it's likely to improve, the real point that I'd like to bring up is that, essentially we were considered for a 3,000 crore type of company. Because that is roughly the turnover that we had in 18-19. So from that level, the point that I'm trying to make is that we had come down to 2,200 crores last year. This year, it is very likely that we will be on similar lines as what we had in 18-19. I think that gives you some sense. But the point that I'm also like to make is that the export business that we have is long-term business, wherein customers are engaged with us in a phased manner. So they introduce certain products in phase 1, then they introduce other products in phase 2, and each of these phases represents typically another year. So as we go forward, we will find that our export business will continue to grow, and that will have a fairly decent growth trajectory for the company, especially going into the next year. This is even assuming that the Indian market will be muted, because if the Indian market grows, it will be over and above that.
Right. So assuming I look at, say, FY24 or 25, when you had also described fairly elaborately the new opportunities you are addressing in the export markets. The steel wheels as well as aluminium as well as the wind components piece. They added up to over 4,000 crores. So if I add up all of that, let's say whichever year that happens, can a 12-13% EBITDA margin be expected? How to think about that?
I would probably leave it at a double-digit EBITDA margin because I really don't have control over what happens on the commodity prices. So it could even happen the commodity prices collapse, in which case, it will happen sooner, or it could be that the commodity prices go up. And unfortunately, we are just coming out of a year where we've had 40 to 50% increase in commodity prices.
Yes. I'm sorry if this sounds, unfair, but, when we talk to your competitor, plus when I look at Minda Kozi's profitability on the aluminum wheel side, obviously, those numbers are much higher. So in that context, your guidance seems somewhat conservative. So, so that's really the context for this question.
Yeah, you have to understand that compared to the two people that you mentioned, they are in the passenger car business. Our business is mainly commercial vehicle, construction, tractor, and windmills. This is the segment that we're playing in. And this segment, we believe, has growth potential. Also, I'd like to mention that Wheels India supplies outside of China. If you look at the globe, we supply about 20% of the global wheel requirement for the construction equipment and the tractor segment in terms of volume.
Sure. Thank you so much, sir, and best wishes.
Thank you.
Thank you very much. A reminder for the participant to ask the question. You may please press star and 1. The next question is from the line of Krishna Kumar from Lion Hills Capital. Please go ahead.
Good afternoon, sir, and congrats for a good set of numbers amidst tough conditions. So can you give some color about a couple of things that you used to talk about in terms of China plus one partner getting incremental market share with the global players, and also in terms of the European foray post the sellout of the joint venture partner? How are we progressing on that front in terms of new business, and what kind of contracts, if you can share some color that you have visibility, sir, now?
Sure. So to give you an idea, we bought out our JV partner during the Corona year last year, and the JV partner, when we had the joint venture partner, it precluded us from quoting on certain types of businesses because it was seen as competing with the partner. Now, if I look at the coming year, we estimate that we will have about 140 crores worth of business that we would not have been able to get if we had a JV partner. So that gives you a context of the amount of business that we won. We've also been very targeted in terms of the customers that we work with, and we've been able to grow our business in some of the customers, and the long-term plans are quite substantial in terms of growing with us, largely because when we had a JV partner, we were looked at as part of that particular group. So they had limitations in terms of increasing the share of the business for one particular group. But now that we don't have a JV partner, we have a lot more headroom to grow in. And that's actually where the growth is coming from. Of course, we have been able to make headway in certain specific European and American customers, but we are targeting others. In terms of the China plus one projectile, if you look at it, it is more pronounced in North America than it is in Europe. But in Europe, I'm finding that people earlier were looking at it purely from a cost angle, but now they are looking at it slightly more from a risk mitigation angle as well. In the US, of course, there are import duties to the extent of 19% on Chinese products, but there's no such duty in Europe. So because of the risk mitigation angle, we are finding there is a lot more interest in Europe than what was there last time we spoke. I hope this answers your question. If you need any further clarifications.
Sure, sir. So also in terms of costs, sir, we do a lot of value engineering and process innovation. So anything that you could talk about, sir, in terms of some benefits, savings that we've been able to achieve through our in-house improvements of process, etc., if there is something?
No, it's a continuous process. As a matter of fact, I chair a cost reduction meeting every 2 weeks. And so this is part of manufacturing is all about continuous improvement. So this is kind of what if you look at our internal meetings, we may have a monthly meeting to review the business, but the cost reduction meetings are every 2 weeks. And it continues to be a focus because we are in competitive segments. And also I think the difference between us and others is we're getting into, in a sense, mass customization. The varieties that we have are quite high. The amount of new product development that they're doing is significant. And I would say that right now maybe about 70% new product development is customer model driven, but the balance 30% is all about value engineering and designing the product to reduce costs.
Sure, sir. Thank you, sir, and wish you all the best and happy Diwali to you and team.
Thank you. Happy Diwali.
Thank you very much. Anyone who wishes to ask any question may please press star and one. The next question is from the line of Raja Kumar, an individual investor. Please go ahead.
Yeah, good afternoon, sir. Can you hear me?
Yes, please.
Yeah. Sir, I have a few questions. First one is on the asset turnover. Sorry to labor on the same point. I think few people have already asked. So my question is, in 2019, you did the top line of 3,200 crores on a fixed asset base of 600 crores. And today, if I see it on a consolidated basis, your fixed assets almost close to 1,000 crores. So if I have to kind of extrapolate, you are almost like 5 times asset turnover in 19. So if given our current base, so is it fair to assume that you will have a potential to do anywhere between 1,250 to 1,300 crores on a 19 price line, because given that steel price has gone up by 40%, so we should expect more than 1,250 crores from a potential standpoint. Is that a fair assumption?
It's difficult to say, but to give you an idea, if you're looking at it, maybe about the mix makes a difference. I have products where I have an asset turnover ratio of 10. I have products where I have an asset turnover ratio of 1. So really, it's a question of what grows relative to the other. But regardless of that, the basic fact that your turnover is increasing and is going to continue to increase at least in the near term for the next year or two, it means that your asset turnover ratio is going to improve. Now, is it going to be better compared to the de-escalated asset turnover ratio of 18-19? I'm not entirely sure. But all I can tell you is that it will go up as business picks up, which is happening at the moment.
Okay, great, sir. And sir, the next question is on the EBITDA. You mentioned that you are targeting a double-digit EBITDA margin. But if I see your again last 5-year profile, your EBITDA margin is somewhere between 8 to 9%, and today we are about 7%. So I just want to know what would be driving your margins to double digit. Is it because you have a better scale, or what is giving you the confidence that you will be able to better EBITDA margin compared to the last 5-year profile?
So two things. One is basically the product mix is changing. So this company was seen essentially as a commercial wheel manufacturer. If you look at it right now, our commercial vehicles represent 22% of our sales. So we have diversified our mix. So the thing is, when we diversify the mix, we've also had to put in capex, because it's new products that we've introduced and new industry segments. But as those industry segments scale up, those are in higher EBITDA margin related products. So as we scale up, we will see the EBITDA increase. So it's going to happen through the mix, and it's going to happen through the scaling up of production in the changed mix.
Okay, got it, sir. So just 2 more questions. So on the commodity inflation as well as the freight rates, I saw some softening of the freight rates, particularly on the dry index. I saw the indexes kind of collapse. So do you see any kind of benefit go forward, and also on the container availability, things are stabilizing? If you could comment on that.
We have with us. Fortunately, unfortunately, majority of the freight has been, ex-works. So customers take the containers. I would say about 70% of what goes out as exports, 70% is borne by customers. So it's only in the 30% that yes, we would probably see some kind of advantage.
Okay, and lastly, on the export benefits, have you baked in anything in the current quarter, because maybe the other income line is again almost negligible. So do you see?
No, we have gained. That is the government has a ROTEP scheme, and under the ROTEP scheme, I think there's 0.5% for automotive related exports and 1% for the non-automotive related exports, roughly speaking. So we have booked that in the current quarter. So whatever is there for the half is there. But going forward, we will continue.
Okay, because I see that line is almost only 1 crore on the consolidated is only 66 lakhs.
Raghunathan, can you chip in here? It comes under Raghunathan, in terms of what we sent SEBI, what is the line under which the export benefit comes?
That comes under it is included in the gross revenue from the operation. And other income is only the foreign gain that comes.
Okay, so it's included. Unfortunately, it's included in the gross revenue, so it doesn't come up. So the other income which is reported here is the forex plus or minus.
Okay, sir. And if you have a number, if you can share.
Hello.
Thank you. Any other questions?
Thank you very much, sir. A reminder for the participant to ask a question. You may please press star and 1. The next question is from the line of Nishant Dwas from ICICI Securities. Please go ahead.
Yeah, hi. Thanks for the opportunity. So, first, my question was on the aluminum wheel side. The utilization has now effectively risen to a 70% level. So, can you give us an update in terms of how have you seen the learning curve of the manufacturing process shape up in terms of this way? Would you expect, is it reached to the optimum level in terms of projections and product losses? And how you also mentioned that domestic you started in terms of the replacement market. So, is that a sign of your confidence on the products relative to the market? So can you shed some light on the process and product on the aluminum?
Sure. So it's a learning process. Whoever invests in cast aluminum wheels, it typically takes 1 to 1.5 years for people to learn how to do it. We are about, let's say, almost a year into the process. So even if you look at relative profitability for other people, it has taken them a couple of years before the profitability has kicked in. So it will be very, very similar for us. In terms of learning, yes, our runner products that we've processed multiple times, definitely the scrap and rejection rates have come down. But we also have a fair amount of NPD because we are ramping up to a base level. And also in terms of capacity utilization, Nishant, I'd like to mention that, we still have that 15 crores or so, which could, tip the balance. And when that comes in, that's really when it would be fair to say that this was the initial project phase 1 and we've completed phase 1. So we're still not at that stage where we've completed the capex that was planned. But production has stabilized, and as a matter of fact, we even invited directors of the company to visit the plant. And customer feedback so far is quite positive. Customers quite happy with us and is asking us to ramp up. Actually, that's the other issue on the export business. Right now, if you look at the current board meeting that we conducted prior to the results, we also cleared capex because we do have backlogs on exports. And we need to plug those backlogs as quickly as possible. So there is also, continued investment which is taking place because the growth in exports has been more than what we had anticipated.
And sir, on the domestic replacement side for aluminum wheels, that is, what are the thoughts around that?
Yeah, so here it's fairly straightforward. To start off with, we supply parts to one of the largest distributors of aluminum wheels in the world, who has about 11 brands, and those brands are already being sold in India. So to start off with, all we are going to do is we are going to look at domestic manufacture of what is already being supplied to India. Second phase, we are going to be looking at expanding the base of products that we can sell in India. And thirdly, we would look at working along with him to also design products for the Indian market.
Understood. So my second question again is on exports. You mentioned about export contribution likely to further rise even with domestic improving. So any thoughts you can share, broad commentaries, what are your customers saying? Is there any segments which are seeing meaningful change in output, both either on positive or some scaling down due to semiconductor or any other supply chain issues, or something on exports for next year?
Sure. So fortunately for us, agriculture, tractor, construction equipment, and the windmill segment are not affected by the semiconductor shortage. At least we have not got any communication from customers related to that. So as a result of that, these are all very strong. The agriculture tractor market, as I mentioned, is showing from a global level, that is outside of India and outside of China. If you look at it, there's in Western Europe, North America and South America, there's about a 30% growth. Also in terms of construction equipment, there is a similar type of growth. And in mining equipment, where we play on the lower end, there is even higher growth which is there. So really, we are fortunate in the sense that we are in upcycle in these three businesses. Matter of fact, if you just step away from exports for a minute, even in our commercial vehicle business and the air suspension business, we are seeing an uptick from what we've had the last 1.5 years. So there are three elements here. One is the segmental, the global markets for each of the segments and them growing. Secondly, there is the factor where we are getting into other platforms of the customer where earlier we were not present. And C, there is also the factor where they might have been buying from China in certain segments and having China compete with us. And in some cases, they are giving us the business in place of China.
Understood. Sir, the associated question was, you mentioned about capital spend. So can you give us what is your broad expectation for this year and any initial thoughts for next year's capital spend?
Yeah, the board had cleared 99 crores of capex in March, and this meeting we've cleared 37 crores of capex. It's expected that this should by and large be on the ground by April or May at the latest. The next year we are still in the works, but I would imagine that next year would see some capex for aluminium, maybe something for the construction equipment and something for the windmill segment. So all the segments are on the growth trajectory. So we'll continue to do that, and we'll keep you abreast once we form up any such plans.
Sure, sir. That's useful, sir. And my last question is on the domestic side. You mentioned on the CV side and the air suspension business looking up. So how are let's say vis-a-vis the tractors? Obviously, the tractors is probably going to be more moderate in growth. So how do you think capacity utilization operates between the two? And is there any fungibility in terms of capacities across these segments, say between tractors and CVs specifically?
Not really. CV is relatively more capital intensive, tractor is not. There's no fungibility of capacities, but definitely, I agree. Tractors are not going to show significant growth because they're already at a high base. But the commercial vehicle segment, I would say, especially on the heavy multi-axle side, ICV side and LCV side, the LCV side and ICV side are really questions of some amount of segment cannibalization and movement of the segment to a slightly higher range. But the multi-axle vehicle segment is gaining partly due to the high commodity prices and mining people using some of these equipment more. It's also driven by the construction equipment cycle, and thirdly by steel and cement, both of whom are doing well to move their materials. So that segment is definitely growing and should see decent growth in the coming year.
Understood. So small clarification, if you the data point specifically on the ROTTEP scheme, have we also booked any previous quarter's gain because the scheme was applicable on a retrospective basis, or we will just for the current quarter?
There might have been some gain from the previous quarter, but I think this the quarterly profits by and large represent what you can expect. Probably you can expect more if the turnover goes up, but on the sale value, that's broadly what you could expect from the company.
Okay. And sir, one final question is on the export realization. So what did we realize on the dollar on a broad basis for the quarter, and for the quarter, what was the dollar realization?
Raghu, can you answer that?
Yeah, the average dollar realization for the quarter was at around 74.8.
Okay. Thank you so much. Thank you.
Thank you.
Thank you very much. Anyone who wishes to ask any questions, please press star and one. As there are no further questions from the participants, I would now like to hand the conference over to the management for their closing comments. Over to you, sir.
Yeah, thank you. So broadly speaking, thank you for your patience, and also thank you for your questions. I'd like to end off saying that on the domestic side, yes, while the passenger vehicle segment is affected by semiconductor shortage, demand in pretty much all the segments remains reasonably strong, and I think that there will be at least growth in these segments in the coming quarters and the year. Secondly, on the export business, typically when we work with customers, we have a plan for 2 years or 3 years, and this year you're seeing the benefits of probably the first year of those 3 years. And as things move along, you will see further growth in the coming quarters. With that, I'd like to thank all of you and wish all of you a happy Diwali. Please keep safe, and wish you a prosperous Diwali ahead of you. Thank you.
Thank you very much, sir. Participant on behalf of ICICI Securities, that concludes this conference call. Thank you for joining us, and you may now disconnect your line.